All right, let's talk about the mystery charts and the methodology in action. We have a new mystery chart this week, and there's the parameters down below, and I'll show you on the chart. First of all, we had a thrust down from all-time highs with a transitional setup. Ideally, for the short side at least, you want to be shorting them off of all-time highs. People get a little confused with the transitional setup because they're looking to sometimes trade it like you've got a sideways trend, or you're in the middle of the trend like this, or if that's a trend, a sideways choppy market or whatever, and you get a transition signal. Well, what are you transitioning from? It's kind of like the candle people. Everything's, this is a reversal pattern. Well, if you're going sideways, what are you reversing? And the other point I want to make is, like, at high levels, the most amount of people can be trapped on the wrong side of the market. But anyway, big thrust down followed by a little bit of a pullback. And the entry is here. The initial profit target is way down there. And then the protective stop, once triggered, is here. I have to look around the curtain to see if it's triggering. Not yet, I don't think. Anyway, I talked about this one last week. This was a stock I recommended as a short, CCL. And those were the initial options plays that I played on it. And then I reestablished a position of 726 puts, and those expire on March 7 at $2.14 each. And then I flipped out half of them for $3.85. I wanted to get a double on that, obviously, or more, just to pay for the position. That's one of my favorite things to do with options is if I pay $1 for an option, try to sell it off at 2. But when you're going deeper into money, it gets a little trickier in doing that, as you will if you're trying to use puts as a substitution for stock. Now, here's some additional options plays that I did. I sold the rest of those puts, those 426 puts at 510. Remember, I paid $2.14 for them. That was the original transaction up here. And I'll show you the actual trades in just one second. And then when I rolled down on those puts, I bought 10, and I'll do that sometimes. I'll kind of double up. And I don't know if that's a good thing or a bad thing, but I figured it was worth the cost in this particular situation and a roll down. And technically, I probably should only roll down for a like amount. If I'm short 4, then just roll down 4. And options get really complex really quick. I'm just showing you what I did. I'm not saying that everything I did was right. In fact, I'll show you some stuff I did was absolutely wrong in 1 second. But I want to walk you through how I played it and how it relates to just outright shorting, in this particular case at least. Now, again, as I just said a second ago, when I buy an option, ideally I want to flip out half of those at a double, and then that way I have a free ride on the remainder. So I flipped out half at 148. And then unfortunately, by the end of the day, these I think these options were expired. Yeah, they were expiring. So I only was able to get 87 cents on the remainder of those, but it's better than poking the eye, slight profit on those. Now, my ego did kick in, and this is kind of an admission of guilt here, and I like to admit guilt because maybe I won't make that same mistake again, knowing that I'm gonna have to admit it to you guys. But I ended up buying 60 March 1950 calls. I'm sorry, this was those should be puts in this particular case, and I'm going to show you where I did a call hedge. But anyway, I bought the puts, and that didn't actually work out. So that actually went to 0. I did buy some calls, and I'm going to walk you through that in just 1 second. And I'm willing to open this up for discussion. And what I was doing was I had a deep in the money options position. And instead of rolling down even further, which maybe that's what I should have done, I don't know, I decided to buy some calls to hedge against those options. And I figured that it's only a few cents, and if the market drops a few cents, then I make that up quickly in the underlying deep in the money put. However, if the market rallies a lot and I don't have some sort of hedge against it, then I lose a delta of 100 every time the market goes up a little bit. Anyway, now here's where I didn't do what I probably should have. The service says to be short 400 shares. or 400 remaining shares in this particular case. And I just couldn't short. I was going to exercise the four of the options, and I just couldn't pull the trigger on that because the market was so oversold, and then now it's super duper oversold. Okay, and I went without a position, so that's kind of like a violation of my rules there. Now let me just show you what I did with these calls. Again, these options were deep in the money, and when I first thought about doing it when the market was way down here, it would have made so much more sense, and maybe a roll down would make even more sense. And I'm open for comments on how I played this and how I should have played it. But my thinking was that, again, if I could buy some calls cheaply, they're going to work against those puts. Now, I seem to remember this position going up quite a bit. And what I could have done at that point is sell that position out, okay? And then that becomes what I call a gamma scalp. And then, of course, I lose my hedge. And if the market keeps rallying, I know everybody's eyes are glazing over, and the options people are like, what the hell? But in hindsight, when I was deeper in the money, I should have thought a lot harder about protecting that open capital position, either by rolling down or, again, buying some calls. But I was a little late to the game in this. And then they did jump quite a bit, and I could have made a quick profit on them, and I didn't. So, but I made $30 overall in that trade, and then that's not even counting commissions. My thinking was, again, that if I could get for 10 cents, so I'm sorry, 7 cents, okay, or $7. For $7, I'm hedging a $100 move against me in the underlying, and then possibly, and I don't know how the Greeks work on this, but possibly slightly more as these options begin to rally. Maybe the implieds will go up or whatever. But that was kind of my thinking there. And again, let's say the market's kind of free falling here. If you buy some slightly out of the money options cheaply, you get a hedge from wherever that level is back to your put position, right? And if the market, let's say you pay 10 cents for them or whatever, keep the math easy, 10 cents, the market has to drop 10 cents because you have a delta of 100, right, on your position for you to kind of scratch out on that hedge. And again, this is where things start getting complicated and get a lot of moving parts. So I'm not sure if this is the right thing to do or not. I'm opening it up for discussion if you guys want to talk offline or whatever about it, or possibly we'll pick it up in the Facebook group. Now, don't tell me to establish a butterfly iron condor, which I have no idea what that is. But as far as calls against deep in the money puts, I'd like to open up a conversation on that. I'd like to learn a little bit more about what I should or should not be doing there. Should I just roll down? Should I be buying the calls? But this is what I did. Now, I do, again, seem to remember this position kind of shot up, and then I was left with a bit of a dilemma. Like, do I take these profits as an individual trade in and of itself? Do you buy the hedge and flip out some at a double? There's so many moving parts, and this is why it gets really complicated really quick. Anyway, there's all the trades that I made. We'll add all those up right now. Now, remember, initially, I think it was on a Thursday when I recommended this, I was able to get some fairly cheap options as opposed to going deep in the money to establish a position, okay, going into Friday. It was either Wednesday or Thursday when I bought them. And I figured it was worth a shot because for this particular trade, in the model account at least, we're risking $2,000 per 100K. And I figured, okay, I'm going to risk 2,000 on a trade, and that's a short, so you could actually, in theory, be risking a hell of a lot more than 2,000. But I went ahead and bought those options. And go in and watch last week's to see what happened. So I paid $100, $101. I was able to sleep at night, not worry about my position. What's $100, right? I know it adds up after a while, but at least I'm positioned as I should be in the position because technically it did trigger. Now it's a little messy because it triggered and it came back up a little bit. It was kind of a hair trigger, so to speak, or triggered by a hair, I should say. And that's why I said, okay, well, for $100, I can at least establish a position because I'm supposed to have a position in this. And then I I forget what day that was. All the trades are listed. But anyway, I picked up options to establish my position at $2.14. Those were flipped out. Remember, 3 at 385 and 4 at 510. Now the S&G trade, and I don't know what the commissions on that were. So commissions aren't here, so it's gonna be a little bit worse than $310. In hindsight, maybe I should have not been so aggressive on those. I kind of felt like it was worth a shot. Maybe I could. Anyway, so that was kind of a bit of a mess up here. Now, one thing I didn't watch on these, and I think I did have an order in a double, so I don't think they've got to a double. So I don't think I could have paid for those. And then that's the roll down position here, 740. And then I got rid of 5 of those, half of those, and that paid for that position there. And then the remainder were flipped out at 87 cents, 435. So we had all that up at 1721, a little bit less probably with commissions, okay? So here's the underlying security, and I don't know where CCL is at the second. Yeah, it's a little further down, so these numbers are going to be a little bit bigger. But had I just taken the outright trade, this is $2,000 round numbers versus 1,700, and again, probably a little less with commissions. Now, just a couple of random thoughts on this. We spent a lot of time talking about this last week. Yeah, my attendance rate just dropped. You know, you start talking about options, everybody's eyes glaze over. There's the potential for a lot of moving parts, as we just discovered. Now you can hedge, you can roll down, should you do both? Should you gamma scalp? Gamma scalping would be you buy those options. You've got a position here and a position here for down, position for up. This goes up a point, you sell them out, it goes back down, you reestablish them, and then sometimes you can do that several times. That would be my fantasy, to be able to gamma scalp on something like this. It's a lot harder than it looks, though. And you know, maybe with options, you really need to make that a big part of what you do. If you could do a lot of option trades, like Larry McMillan could do all these crazy stuff because that's what he's focused his life on. He's also an engineer, or educated as an engineer. So all this math and gamma and delta and all these things make a lot of sense to him. I'm just trying to use puts as a substitution for stock. And the main thing I should be doing, if you go back and all the way back to, I think it was Dave Landry on Swing Trade, I talked about putting puts in. And by the way, you can get it at davelandry.com/free-book, and you should be able to get that for free, along with my other 2 books. I'll make it up in volume. Don't worry about that. But anyway, ideally, you just want to go with the deep in the money puts. But then, of course, when you have to roll down and everything else, it gets more and more complicated. Now, my problem was I didn't want to reestablish a position at oversold, and the implieds jumped on the options, of course, because the market's tanking. The stock had been tanking, and it's like, okay, now it's going to cost me a lot of money to get in these options. Should I just have shorted? That kind of defeats the whole purpose of using the options as a substitution for stock. Now, it does allow you to sleep at night, but of course it does come with a mental cost and the potential to be without a position. A lot of thinking goes into do I gamma scalp, do I hedge, how do I roll down, and all that. And I'm not an expert in all these things. I just want to show you some of the problems that you might encounter. So the buy at B, I talked about this one last week. Go and watch the presentation. And I bought, this kind of just barely triggered above the day 1 high. For this particular case, the day 1 rule was in effect. And I bought 400 here. My IPT was 2 points, so my stop was 2 points, and then sold half. So here's where we are now in this. The position is still open, at least for now. I haven't checked back lately. And again, when that happens, the stock goes to break even. And just in case somebody here is new to the methodology or watching the presentation new to the methodology, we like to take that short-term profit. Hopefully it happens short-term. I know I just said hope. And then we get our stop to break even on the remainder of the position. And then if the market does turn into the mother of all trends, we gradually let that stop loosen and we ride that trend out as long as possible. So those are the first 2 trades on that. The next trade will be stopping out. All right, any questions about anything so far? I can't promise you that I can answer any option questions, but I'll give it a shot. I spent 14 years as a consultant, but I was just doing technical analysis to a hedge fund that just traded options. And they were doing some, there wasn't a lot to learn from what he was, there was a lot to learn, but it wasn't like a lot of the more complex things and all. Anyway, my job was just to predict the market up, down, and sideways. And after I said 100,000 times, it's kind of like, looks like it's going up. Okay, well, how far is it going to go up? Like, I don't know. I'm just a trend follower. It's going up, you know. Well, what do you think? I don't know. 3 points. How long is that going to take? I'm like, I don't know. It's so. As I often joke, if you could get price, direction, time, and volatility, if you can predict all 3 of those things, you could trade options. Anyway, the VIX only matters when it matters. And years ago, just to give you a little background on this, when I first worked with Larry Connors, he had some VIX systems. I was going to do programming for him and whatever, and he explained in analysis, he was explaining to me that the VIX has a reversion to the mean characteristic, and he had some systems built around it. So I kind of piggybacked off of what he was doing. I took his explanation literally and said, okay, well, reversion to the mean. What's the mean? The mean is the moving average, okay? So I started messing around with 10-day moving average, and I developed some VIX systems. And they're pretty good systems, if I say so myself, but I'm also going to say I would not trade them because they absolutely print money for a while. That's the good thing, right? But every now and then you just get really creamed with a pure short-term system. You have to have some open-ended, longer-term type of characteristic, and that's why we're hanging on longer term, hopefully hanging on longer term to these positions to ride out those longer term trends. So it's like I went back in and looked at this VIX stuff a while back, and you can go and look at the presentations on YouTube, youtube.com/Dave Landry, going way back. And it absolutely printed money, but then this little thing called COVID happened, and you would have blown up probably just on that. So not a huge fan of short-term systems, but that doesn't mean that they don't have their uses. Now, again, the VIX only matters when it matters. So just to show you what I have going on here, that's the VIX. This looks a little bit more complicated than we normally do, but trust me, it's not. That's the S&P 500 overlaid, okay? And that's just a 10-day simple moving average. Now, what I have down below is the high, the low, and the close away from the 10-day simple moving average. And then you go back and look at my old VIX systems published 20-something years ago, I was using 10% as a good round number, and I still do today for when a VIX is stretched. So when the VIX is stretched 10% or more away from that 10-day simple, either up or down, okay, look for a reversal in the markets. Now I added the high and the low end just to kind of give me a reference on a day like, let's see, like a day like this where you get a spike in the VIX. So I could see intraday, it's like, okay, we're 40% away from that 10-day simple. Maybe we're getting close to an intraday bounce in here. And I might want to think about squeezing off a little day trade with not big money. Don't bet the form on something like this on a reversal trade. I know I'm a trend following moron, right? So that goes a little bit against that trend following moron mantra. But you can see if you go back to, that was last December, we had this big spike in the VIX, and it actually closed up there. And then if we zoom in on that, you could see that you had a nice spike in the VIX, and then the market was imploding on that day. Now, that doesn't mean you should rush out and buy the market, because the market took a couple of days to find its way, but then it finally began to reverse. So that's the kind of thing you could do with the VIX. I would only trade it especially since I've done a lot of follow-up research over the years. But that's one thing I probably need to add to Dave Landry on swing trading is don't trade the VIX systems outright, and don't trade for a pure short-term gain, okay? But I think it's worth paying attention to when it's worth paying attention to. When it gets really stretched, you might want to start paying attention to the VIX. When it just dies out and goes sideways for a while and it's not really stretched one way or the other from the moving average, then there's nothing to do. So you can see here back in August, we had that huge spike in the VIX. And according to this little indicator down here, and if you zoom this in a little bit, you can get this. These are the entire formulas. And I'm just looking at yesterday's moving average and yesterday's price as a reference, because today's price is obviously a moving target. And then I pit today's price against that to let me know where I am within that average. So I don't factor today's price into the moving average. Okay. So that's the close right there. You can see it's still closed like 100% away from the moving average. And then notice that the market did bottom out afterwards. Now, here's where we are now. Now, I'm sure it's probably spiked up a little bit. We'll take a look at the live VIX in just 1 second. But coming into today, and this is as of yesterday's close, that VIX was beginning to correct down to the moving average. And by the way, the reason I use the moving average is years and years ago, Larry Connors had a VIX system that was based on an absolute price level in the VIX. And then the volatility shifts over time. So I think 15 was his number. And that might become relevant once again. But he found out over the coming years, remember things change, right? That you needed more of a relative type of metric. And that's where I came up. And I don't remember what he used, maybe RSI or something, but that's where or some other oscillator, which would work fine. That's because it's reversion to the mean. So an oscillator will work as opposed to trend following. So I decided just take him at face value again and just use the mean, which would be the moving average. And you can see we did kind of implode, and I would imagine we're probably spiking back up at the moment. I can't see around my screen here. I'll just take a walk. No, it's not really spiking as much as I thought it would. Looks like it spiked a little bit, but not much. Okay, a couple of things on trading the VIX. It only matters when it matters. So it's kind of like the 50 and the 200-day simple moving average. If you look at my charts, first of all, mostly I use blank charts. And then when I do use a moving average, it's the 30 simple and then possibly the bow tie moving averages. But when the market gets a little iffy, I like to put that 50 simple in, that 200 simple in, simply because it's well watched. The VIX on a similar vein is when it's stretched away from the market, stretched away from the moving average, then you need to pay attention to it. Now, again, high or low is relative, okay? So we could adjust to a new VIX at 30, okay? It's probably not going to happen, but it could happen, right? Just like Connors, 10 was about right for the VIX, and then 15 was kind of crazy. Well, those numbers, throw those numbers out the window in nowadays, right? Now, you don't want to be a hero. You want to actually wait for that reversion to occur. And I wouldn't take position trades based on this, but do use it as a tool to help you know when, hey, this market is super duper oversold. We're due for a bounce. Maybe I need to lighten up on some shorts, or if I'm looking to take profits and I'm just a hair below or a hair above, whatever, that initial profit target, maybe I should bail on some of that. Although major bottoms can start with a VIX spike, okay? So if you go back and look at those spikes in that chart, and again, I'll give you the formulas, or you can go in and copy the formulas. If you look at those spikes, especially when you're measuring the distance away from the moving average, you can go and look at those spikes, you're going to see that that's right around the time the market's bottomed out after a really big spill. Now, do use it as a gauge for overbought, oversold. So just rewind a little bit. VIX measures, it's a hypothetical number, but it's based on a formula looking 30 days out, a perpetual 30 days out. I don't want to dig too deep of a hole here, but just know that it's measuring volatility. And the way it measures volatility, it's measuring the implied volatility on S&P options, S&P 100 options, I believe. And you don't need to know how electricity works to flip a switch, right? But it does kind of help to understand what you're looking at. And the implied volatility is what the market is implying these options are worth, okay? And when you have a market that starts coming unglued, people just buy puts at any cost, and the price of calls also goes up. And that's one thing that people probably don't realize is the VIX is calls and puts, okay? Hypothetical calls and puts at the money 30 days out, and it's a perpetual, again, 30 days out. When the options get really low in price based on the implied volatility, okay, then that suggests that the market has become complacent. So you got complacency and then panic, okay? When it gets really complacent, get ready for the market to likely tank unless everything kind of corrects a little bit. And when it gets really spiky to the upside, panic has set in, so watch for that market reversal. All right, that's it for the VIX. I might, if it gets stretched again, really stretch at some point, I might look to do like some intraday stuff. But boy, I tell you, it's been really, really tough with this market. Is again, it feels like it needs a washout. It's been really tough to try to go in and take those little intraday trades on a bounce on this stuff, which I probably should be doing anyway. Frenchie says, should we use VIX or VXX? I like the original VIX, VIX, but that's not based on any empirical research, okay? So maybe take a look at both, see which one you like best. The same formulas in all of the analysis is the same, and we'll take a look at that when we get to the live charts, if you don't mind bringing it up again. All right, just real quick, TFM 10% system. We are, as of right now, we're not a sell. Remember, you got to close below the 50-week moving average and close 10% or more away for the 50-week closing high. And these zones are in here, and go in and watch prior presentations for a lot more on this. But like right here was your last sell signal in the S&P, and the buy is a little bit more stringent to avoid a little whipsaw there. And that was the last buy way back in December 2023. I thought that was right. Anyway, now we're still with between 5 and 10% of all-time closing highs. So that's kind of the caution zone. And then if we get 10% or more away and below the moving average, well, we're already below the moving average, so that doesn't matter. So now the 10% line is the sell point. When I designed this, as I've said quite a bit, I wasn't paying attention to the fact that it was a calendar chart and not a rolling chart. So instead of Monday, Tuesday, Wednesday, Thursday, it's Friday, okay? So each one of the bars of this chart is Friday to Friday. That's how my analysis was done. So that's how I'm going to follow the system and not change anything. The last buy was there, 2 bars of Landry line above the 50 simple, remember, and within 10% of the 50-week closing high. So the sell is a close below the moving average and the 10% line, okay? Which those two are pretty much the same right now, okay? So any close below those two, obviously you would exit, but that's based again on a calendar chart. And the reason I didn't exit, I guess we're below that now, today or yesterday, whenever we first got below that, is because again I did the analysis on a weekly chart, and it's a little painful. But let's see what happens tomorrow. If we jump back above it and close back above it, then we stick with this position. And I do have 100 shares of the Qs, just full disclosure on this, as I discussed before, from 319.49. So it's been a pretty good run. In the end, though, we're going to give up about 6K, we being me, on that position. That's gonna suck, but you know, it happens. That's longer term trend following. Anyway, Landry 100. Any questions on any of that so far? Okay, just real quick, there's a couple things I want to show you this week with the Landry 100. Not much. As I've said before, all these are bought at brand new highs. You can see that we're getting fewer and fewer winners in here, and fewer huge winners. At some point, we had some like 200 and 300%. And now this is our biggest winner at 159%. And this was bought, again, as the market's making brand new highs, and then you go to right there. So far, it's 157% gain. But you can see we've given up quite a bit of those gains from this peak, which was probably 200% or more back then. Now, as I've said 100 times, I'm not actually trading this. I did experiment a little bit, going right into a bear market, of course. Whenever your ego gets kind of big, you get slapped right back down in the markets. But a couple of random thoughts. It's a great exercise, and I would encourage you to do something similar if you had the time and inclination. But momentum ends badly, and I'll show you a picture of that in just one second, or not a horrible picture, but kind of an idea. RS in a bear market is okay, but they eventually find you. Okay, so one of the myths I wrote about, I think it was in Layman's, which you could also get for free, by the way, is that there's always a bull market somewhere. Well, there's not always a bull market somewhere. And even if there is, like lately, these defensive stocks have been doing well, like medical devices. Well, medical devices recently got creamed, as you'll see when we get to the live charts. So it's kind of like a sinking tide sinks all ships. Eventually, they will find you. So you got to be really careful playing the relative strength game in a bear market. Now, the great thing about this, it's been a great way to see where the money's flowing. So even though I know that eventually, if this market continues to tank, the major drugs and these other defensive areas that are popping up as momentum stocks now that I'm putting into the Landry 100, it's not real money, again, except for a little experiment I did. But I know that they'll probably get whacked. It's a great way to see the money flows. Like, okay, I think by doing that Landry 100, I'm like, oh, wow, I'm getting a lot of drugs in here, major drugs. I'm getting a lot of lower HV stocks to boot, a lot of the thicker major drugs. So this foods. So this suggests that we're getting closer and closer to kind of a bearish type of market where people are looking for those defensive stocks. So it's a wonderful way to see where the money's flowing. And this is just an example of like the defensive stocks. I don't have any good examples of momentum ending badly, but if you go back and look at that, what stock was that? KC, you gave up a lot of those gains, okay? But here's one that was doing fantastic, and then now it's beginning to tank. And so this was one that was up fairly nicely, maybe 10, 15%, and now it's at a negative, and that's ABT, so that's a major drug, Abbott Labs.